So namaste and welcome back to the lecture 2 of fundamental analysis of companies. In this lecture, we'll be learning the profit and loss, which is also known as the income statement. And just remember, we are currently on the section 1 company analysis of our course. And after learning the income statement, we are going to proceed to all the next topics. So let's start. So let me ask you a question. Wouldn't it be an stupidity to learn everything and note down everything for every company? I mean, there should be a knockout criteria, right? I mean, if some of the first 5 or 10 criteria fail, then we really don't have to list everything and check. So in this slide, we basically wanted to show that how we can see a health of a company using a bird's eye view. And there are several terms in it, which we will be understanding in detail later. So this slide will be repeating. But just to give you an idea that you really don't have to list down all the parameters for all the companies. We do have a knockout criteria, and if this criteria doesn't met, we really don't proceed further to analyze the company in detail. So let's proceed to our lecture. Now, if you ever get a chance to look at a company's profit or loss statement or at a balance sheet, you might notice there are two ways to look at it. One is a standalone statement and the other is a consolidated statement. So the difference is that in the consolidated statement, you also include the subsidiary and the affiliates. So if a parent company holds more than 50% or 50% of a share in any company, that becomes its subsidiary. And if a parent company holds between 20 to 50% in any company, that becomes its affiliates. So we generally recommend you to use a consolidated statement because that governs the net profit loss or the net balance sheet of a company. So let's try to understand the income statement in a simple way. The first thing to remember is that the income statement consists of 5 sections. The first section will be your revenue. The second is your expense. The third is your profit. The fourth will be your interest, and the fifth is going to be your taxes. Let's try to understand this easier with the help of an example. Suppose I sell a mobile phone for 20,000 INR. Now this 20,000 which I get will be my revenue. But in order to sell it, I first have to buy it, right? So that is my cost of goods sold, which we also know as COGS. Suppose I buy it for 10,000 INR. So the difference is going to be my gross profit. Now you have to remember, this is not my only expense. I also have to do an advertisement to sell my cell phone, and I also have to pay the utility bills for the store in which I'm keeping it. That is my operating expense. So after subtracting my operating expense from my gross profit, let's say my operating expense is 5,000 INR. The remaining is my operating profit, which in this case will be 25%. Now there will be some other miscellaneous expenses too, like suppose filing a lawsuit or other expenses. Now once we subtract these other expenses from my operating profit, what I get is my EBITDA. EBITDA basically means earning before interest, tax, depreciation and amortization. You don't have to worry about the terminology. It's already written like EBITDA, and the terms itself explains itself. So the depreciation and amortization we are going to study in the next slide. But before that, let's try to break EBITDA even further. So once you subtract your depreciation and amortization from EBITDA, what you get is your EBIT, which is basically your earning before interest and tax. Now remember, this is not your profit. You still have to pay the interest on the loans which you have taken, and you also have to pay your taxes to your government. And after paying your interest and taxes, what is left is known as profit after tax or PAT. The first thing to remember here is that you have seen that we have 3 profits. One is gross profit, the other is operating profit, and the third is your profit after tax. All these 3 profits are equally important, and we will be covering this later in the financial ratios, that how we can compare these with the help of the peer industries and see which one is doing better, which company is optimizing its cost much better than its peers. The second point to be noted here is that we have some new terminologies. The first one is depreciation and amortization. The second is cost of goods sold. And the third is your operating expense. So in the next slide, let's try to understand them in detail. So the first terminology which we have to understand is the cost of goods sold, which basically means any cost which is directly related to manufacturing or during making of that product. Say suppose you have the raw material, you have a packaging material, you have the direct labor, or you have the quality control. The only thing you have to remember is these costs should be directly related. Let's try to understand this better by understanding the second terminology also, which is your operating expense. Operating expense basically means after you have made your good, you have further other expenses like you have a rent to pay, you have a marketing to be done, you have utilities bill to be paid, and you also have a license agreement or a license fee to the government or to a vendor to be paid. Now it sometimes it becomes very difficult to actually understand the cost has to go between COGS or it has to go to operating expense. The easiest way to understand is to ask yourself whether this cost is involved directly in making the product. If it is not directly involved, it has to go to the operating expense. Now, one question you might ask, why do we have two costs? Why not just combine them together? Anyway, I am paying them. And when I subtract both of them from my revenue, that is my only profit, not considering the depreciation, amortization, interest, and taxes. So the reason being, these expenses can actually, by bifurcating them into COGS and operating, we can actually quantify whether the company is doing better or bad as compared to its peers. So let's take an example. Suppose your gross profit is 12% and your competitor's gross profit is 24%. This basically means that your competitor is able to make, say, suppose the same product with a cheaper cost. And that basically says that his resources are more optimized. Similarly, we do for operating profit. If my operating profit is higher, that basically means that I have optimized my operating cost. My marketing costs are less, my rent is less, and other operating costs. So by bifurcating them into COGS and operating, we actually can compare these with the help of the peers. Now the third thing we have to understand is the depreciation. So always remember that depreciation goes for the tangible assets. Tangible assets means the assets which you can touch. Now why can't I just put them directly into my operating expense or on my COGS? The reason being, if that would have been allowed, every time I make a profit, I would directly go and buy something. So I will go and buy a land, or I will go and buy some high-end machinery, and I will never pay any tax to the government because it's all subtracted from my revenue and my net profit is zero or in negative. So what government has allowed is that anything which is tangible and which has a long-term use, so you buy a land or you buy a car or a machinery or a HVAC. By the way, HVAC means heat and ventilation system. You can call them as an air conditioner also, but it's different. So anything which can be used for a longer period, you cannot just subtract them right now in this financial year. You can subtract them by percentage, and that percentage is fixed by government. And you can subtract them or depreciate them year by year slowly. The second part is amortization. So amortization is for your intangible assets. Say suppose you have a patent. Now if you might know, filing a patent costs a lot of money, but the patent would be valid for a number of years. So you can basically amortize your patent for a number of years. Same goes for trademark or advertising contracts. So you have to be very conscious that whatever you buy, suppose you are a business owner, whatever you buy, whether you can put them into COGS, operating expense. If not, you have to depreciate it. You cannot directly claim it and save the tax. So this is the reason why we have these separate entities and why it's important to understand them. For analysis, we would be using screener.in. So you can type this in your browser and you can type the company name, say Tata Chemicals. This is just an example. And on top, you can find the headers. So the quarterly and the profit and loss. This is basically your quarterly income statement and this is your annual profit and loss statement. You can also see the option for consolidated or standalone statements. So let's follow along the cursor. Don't try to read all the numbers. You might get confused. So on the top, we have columns which list the year from March 2012 to March 2023. And the rows are basically your items which you have to look through. So if you remember, the profit and loss statements have 5 broad categories, which is sales, expenses, profit, interest, and your tax, right? So if you see the sales, I mean, this is your 23, this is the latest data, and this is the oldest data. So if you look from left to right, you can see the sales have increased. But just pause for a second and think about it. Suppose I am selling 100 units of car every year. And in the last 10 years, if I still sell 100 units of car, the amount in crores for my sale, would it remain same or would it increase? Obviously it is going to increase, right? Because the inflation is rising, the costs are rising, the cost of cars are rising. So even though my sales unit remains same, my sales revenue, my sales in crores increases. That should not happen, right? I mean, when you see an increase in sales over the last 10 years, it should account for inflation, and still there should be growth. If your unit of sales remains same, that means you are not growing. That simply means that your sales have remained constant, and because of inflation your numbers have risen a bit. Okay, so if you click on the plus sign in the sales, you can actually see the growth percentage. And let's go to the second part of your expenses. So the expenses which you can see is basically you can see which expense has higher percentage, like material, manufacturing, employee, or others. So what is the takeaway from here is, say let's analyze the employee cost. Now you can see the employee cost in 2019 was 12%, then it increased to 13%, then it stayed to 13%, now it has decreased to 10%. So somewhere or other the employee cost has decreased. And I'm saying it's a good or a bad thing wouldn't be a right time to say it right now, because we really don't know that the employees costs have decreased because the revenues are decreasing or because the company is optimizing. I mean, if it is the later case, then it's a good sign. Otherwise it's a bad sign. If a company is firing up their employees over a year, it's not a good sign. Now you can also see that the material cost, which accounts for 19 to 23%, is just now only 19.5%. So they have reduced it a bit. So this is our expense part. Okay, now one thing you might be wondering, that in our last slide we have actually understood it, like we have our cost of goods sold, we have our operating cost, but you are not able to see those numbers here, right? So you don't have to worry. The aim of that slide is for you to understand the fundamentals of how the whole profit and loss statement is calculated. Now, not everything will be listed in all the websites, but you don't have to worry. You don't really have to even calculate it. When we go to our fundamental financial ratios, you will be seeing the gross profit margin, the operating profit margin, and the net profit margin directly. So you really don't have to calculate them. Now, what we have to understand is the operating profit. Now, if you take the last 5 years data from March 2019 to March 2023, you can see the operating profit has almost doubled. Now, this is a good sign. Operating profit, as you know, is the profit from which, when you subtract your cost of goods sold and your operating expenses from the sales, you get your operating profit, right? And OPM percentage means operating profit percentage. This basically means your operating profit divided by your sales. The next is your other income. Now, this column becomes interesting because sometimes what happens is there could be an income because of sale of an asset or sale of a land. Like if you see here in 2020, there was a 6,000 crores of other income. I mean, you can't really call this an other income, but you can actually go to your annual statement and you will find where is the 6,000 crores coming in. It could be because of a sale of a land or sale of an asset or some maybe sale of one of its division, something like this. Okay. Now, the other thing you have to see are the exceptional items. If there is any rise in exceptional items, you have to go to your annual statement and figure it out. So let's minimize this. Now, after your other income is done, your interests. So your interests more or less have remained same from 300 to 400 crores. That means every year Tata Chemical is paying 300 to 400 crores of interest on the loan it has taken. It has not increased, so that's a very big good sign, because there are a lot of companies whose interest amount keeps on increasing because they keep borrowing more and more money from banks, and that becomes bad sign because your interest keeps on increasing, and which gives a big dent on your net profit. The next is your depreciation. You have already learned in the past slide how we depreciate the assets, which can't directly be subtracted to your income, but you can subtract them over the time. And always remember that land cannot be depreciated. It directly goes under the asset column. So if you own a company and suppose you make 1,000 crores and you decide to go and buy a land worth of 1,000 crores, you are still going to pay tax on the whole of the 1,000 crores. You can't really do that. Okay. So this is one thing. And now let's go to the next part, which is our profit before tax. So your profit before tax, I'm not really a very good fan of your profit before tax. I generally prefer to look at your gross profit and operating profit, because that's what businesses do, right? I mean, I always want to make this figure as less as possible so that my tax goes as less as possible, right? And the next column is your tax percentage. So out of whole, 11% goes to the tax. And then you have your net profit, right? If you click on the plus sign, you can actually see various headings, and you can read through them, but I would not suggest you to go them over the initial time. But if you do get some free time, please explore all these headings, try to understand their meanings and try to correlate them. Now the next part is your EPS, which we will be discussing later in one of the lectures, so we are not going over it right now. So this is how your annual statement or a profit or loss statement looks like, and this gives you a good brief insights on the income statement. So the three key takeaways from this profit and loss statement would be: the first, that the sales over the past 5, 10 or 3 years should have been increased. And you have to account for inflation. It shouldn't be like the sales increase just because of inflation, okay? The second thing is going to be your operating profit. So your operating profit over the past few years should increase. Like if you take an example, like for March 2019, for a sale of 10,000 rupees, the operating profit was somewhere around 1800 crores. Sorry, for 10,000 crores, it was around 1800 crores. And for the sale of around 17,000 crores, it was somewhere around 3,800 crores. So you can see, although the sales has not been doubled, but your operating profit has been doubled, right? And that basically tells you that somewhere either the cost of goods sold have been optimized or your operating cost has been optimized. So that's a good sign. So this is how you have to see. And the third point which you have to see is that your interest is not increasing. I mean, it should not happen that companies just keep borrowing the money and their interest costs keep on rising, unless and until that industry or that company is expanding at a very fast rate. If you take example like Adani Industries, they're expanding at a quite fast rate, so they are borrowing a lot of money. But unless otherwise, it should not happen that your interest costs are increasing too much and you don't have sufficient cash flow to cover it up. And now what is cash flow, we would be learning in the next class. So yeah, so these are the three important key takeaways you have to always look through while seeing an income statement. So that's all for the lecture 2, income statement, and we hope you have learned something today. Keep exploring and keep strategizing. See you in the next class.